Welcome to the Rick Helps Real Estate Show. What a week, huh? Or at least what a weekend. We've slapped tariffs on Mexico and Canada. What does it mean? I don't know. I'll share some thoughts on where I know it's affecting the interest rates, your mortgage rates right now, and that's really all I know. I have some opinions where I think things might shake out, but I'm no economist, so for now, let's just take a look at what the effect is on mortgage rates when tariffs are slapped on two of our trading partners. And right now, it is making the bond market a little bit nervous. And this is because there's a belief with the bond traders that tariffs mean inflation. Now, they're going to have to stick around for a while for that to happen, but the so-called smart money in the room says, well, here it comes, and this is right here, the reaction to the tariffs that have been placed on the bond markets, and you're going to see that shake out over here. We're right now at 7.05, and all bets are that that number is going to jump up on Monday when the markets open. So we'll see what happens. Tariffs, it's interesting. We've got tariffs on lumber. We've had tariffs on lumber from Canada for a long time, and that's where we get our soft lumber. So that's already been built into the cost of construction. Lumber has already gone up, gone down, gone up. I don't expect a whole lot to happen there. And, maybe it'll get worse. Hard to tell. As far as any other commodities that would affect real estate, obviously energy. We get a lot of energy from Canada. Boy, I don't want to see my price of my avocado toast go up in the morning, but that's going to happen. But then again, tariffs can sometimes be used as a negotiating tool, and sometimes they come and they go rather quickly. So who knows? And I'm not going to attempt to say, here's what I think is going to happen. I'm saying this is what we're already seeing. Now, as far as our real estate market in Phoenix, it is getting slower, not slower, but the numbers are starting to really show up based on the low activity we've had in November, December, and January. And here's one of the first things that come out here, and this is active listings. The new listings are not coming on by leaps and bounds, but because the sales are not there to gobble them up, we continue to grow. We had 20,061, 20,933, 21,704, and 22,169. What I am noticing is, and it was kind of surprising to me, is that the number of new contracts have gone up to a little over 3,000 the past 7 days, and I really didn't see them going up much over 2,600, but it is the first of the year. We're still lower than last year. I should have paid more attention to that, but it's higher than what I thought. But it's still not affecting much. The gap between the number of new listings and the number of new contracts is not, it's big enough to put pricing pressure on the downward side. And you can also see that our contract ratio is not that rosy right now, but it's getting better. But again, that's because November, December were already so slow. But if we look at 118, our contract ratio is 28, and then today it's 33.6. So that's improving. More listings going under contract, and I'll show you in just a moment where that activity is happening. But wow, the shocker is this. Look at our months of supply. 5.2, folks. That is a big jump. If I just go, let's see, 20, 24, 25, there it is, 5.2. If we put in the other years, this will just show you how much it's climbed. Normal's 4 to 6. Here you are, folks. Welcome to normal. That has affected a lot of price changes. The optimism of pricing in January is starting to show its ugly head and coming back down to a little more realistic pricing, where we have jumped to 2,774 price cuts, up from 2,504. So we went up by about 200 homes. Now that's to be expected, and that usually always happens every February. The only difference is this time the number is a lot larger than it has been. Because November, December, although they were slow, people were still very optimistic about what the new year would bring. New president, here we go. Everything's different. It's got to be better. And once you find out it isn't, you got to start reducing your price. The thing that surprised me a little bit today, but then again, maybe not, was our expired listings last month. Remember at the end of the year, they spiked to something like 2,700 expired listings, the largest number we've seen in like forever. And today we're back down to normal. Expired listings about 650, 674, something like that. So expired listings always go up at the first of the month, and then it shakes out. And so they haven't jumped because most people listed their house now have listed it like for the 1st of January. So they're not going to do a 30-day listing. They're going to do at minimum a 90-day listing. So the end of March, I expect another spike in expired listings. Not to the extent of what we saw at the first of the year. Like we're about 600 now. We'll probably be 700 in February. But when that 90-year clock ticks, and most people are expecting an offer within 90 days and they don't get it, that contract's going to be expired. They probably didn't sign anything longer than 90 days. Some people sign them for 6 months, and you can see that on the MLS. I encourage you to have your agent do a search on any homes over 90 days on the market. It will surprise you greatly. When you look market by market, I'll start at the bottom first and show you that anything under 100 on a CMI, Cromford Market Index, is considered a balanced market. Anything below 80 is considered a buyer's market. And look at where this is happening. It's Goodyear, Queen Creek, Surprise, Buckeye, and Maricopa. That's where all the new builds are. Maricopa, you are getting beat up big time in the resale market. 48.3. If you're looking for houses there where prices are going to have to be reduced to sell, that's it. If you're looking to list in Maricopa, you're going to have a hard time. You're going to have to be a real bargain down there. Now, Chandler, not so bad. 156, an increase by 4%. Tempe's hanging in there. Scottsdale, Paradise Valley, Gilbert, Fountain Hills, Phoenix, and a little bit in Mesa. And the only one that didn't get better was Fountain Hills, that went down by about 50% in the CMI index. But the East Valley remains strong. Not robust, but strong. Promising for a seller's market. Now, the challenges for you as a seller, remember, buyers don't tend to look at this neighborhood by neighborhood. They just go by the news. Sales are slow. Things are flat. I'm going to send you a really low ball offer. So you have to be prepared for that. You're going to have to contribute towards closing costs. The average right now is about $10,000. But what I'm saying is the buyers, they're probably not mentally dissecting much from Buckeye and Maricopa versus Chandler. Oh, I hear it's tough. Sellers are going to want to lower their price for me to participate. You're not going to be able to hang in there at your highest price above what your neighbor sold a few months ago, but if you're priced correctly, you will sell it. You may not have to give back as much on seller concessions as you think because of your good CMI reading, and that's what's going on in the market in those areas in the East Valley. As far as going back to the tariffs now, all we can do is wait and see, but we're going to feel it Monday. And we're going to see the news going back and forth and back and forth, and salvos being shot across, a lot of politics being played, and a lot of anxiety. And with anxiety breeds volatility. So interest rates are going to go up, down, up, down, up, down. There isn't any indication that rates are going to come down. And that's based on the meeting, the press conference that the Fed had this week in the meeting, saying, we really don't see any rate cuts anytime soon here. We're going to have to watch and see what happens. That disappointed a lot of people. But remember also, we've already had a 100 basis point cut with the Fed, and rates have gone up. So don't hang your hat too much on what the central bank says. This is all based on the bond traders saying, we hear what you're saying, but we're not that optimistic about progress on the inflation battle. And now with tariffs being implemented, they're dug in like a tick. Yep, we knew it. We see inflation coming. Here we go. We want higher yield on our 10-year bonds. So that's where we're at. How long we're going to stay there is anybody's guess. How long these tariffs are going to stay is anybody's guess. But stay tuned here. We'll continue to track it. If you have any questions, shoot me an email at rick@rickhelps.com. And hey, have you signed up for my newsletter yet? The link's down below. It comes out every Monday morning at 7 o'clock. Take care. Have a great week.